Fatima al-Rashid worked in the Saudi Finance Ministry for 9 years tracking oil revenue projections. In January, she watched the numbers collapse in real time on her terminal. Brent crude falling below $70, then $65. Budget projections turning red across every ministry dashboard, and a single classified memo arriving in her inbox. NEOM's discretionary budget had been cut by 30% effective immediately. No public announcement, no press release, just a quiet directive from the finance ministry to reduce expenditure. And here's what Saudi Arabia desperately does not want the world to discover. The kingdom's entire economic transformation depends on oil revenue that is disappearing. In this video, I will expose the oil revenue crisis that is silently gutting Vision 2030 from the inside. I will reveal how falling crude prices have forced emergency budget cuts to the most expensive construction project in history. And I will show you the data that proves NEOM cannot survive without oil prices that no longer exist. Less than 1 week ago, energy market analysts confirmed what Saudi budget planners have been scrambling to address since late 2025. The oil price floor has collapsed. The International Monetary Fund calculates that Saudi Arabia needs oil at approximately $96 per barrel to balance its national budget. Brent crude is currently trading near $65. That $31 gap per barrel translates to roughly $100 billion in lost annual revenue. $100 billion. That was supposed to fund everything from schools to NEOM. Saudi Arabia produced approximately 9 million barrels per Dalton Y through most of 2025. 9 million barrels per Dalton Y at a $31 per barrel deficit. The arithmetic is devastating, and the price decline is not temporary. 3 structural forces are pushing oil lower with no reversal in sight. First, global demand growth is slowing. Electric vehicle adoption in China and Europe is displacing millions of barrels of daily demand. The International Energy Agency projects peak oil demand before 2030. Second, OPEC discipline is fracturing. Saudi Arabia has been cutting production to support prices, but other members are quietly overproducing. Every barrel Saudi Arabia holds back is replaced by a competitor. Third, American shale production remains resilient. U.S. producers have become more efficient, profitable at lower prices, and continue to add supply that undercuts Saudi market share. The Saudi government's response has been to borrow massively. The kingdom issued over $26 billion in sovereign debt in 2025 alone. The national debt has more than doubled since 2019, and there is no sign of slowing. The debt trajectory is staggering, more than doubled in just 7 years, and still climbing. But borrowing has limits. Credit rating agencies have already placed Saudi Arabia on negative outlook. Further downgrades would increase borrowing costs across the entire economy. One senior economist at a Gulf-focused investment bank who asked to remain anonymous described the fiscal reality. Saudi Arabia is running a structural deficit that gets $31 worse with every barrel it produces. The math is simple. At $65 oil, Vision 2030 is unfundable. Not difficult to fund. Mathematically impossible at the announced scale. The budget cuts are already visible at NEOM, and they go far deeper than the official narrative suggests. Construction activity at the line has slowed to maintenance levels. Satellite imagery confirms that heavy earth-moving equipment has been removed from multiple sections of the trench. Worker camp occupancy has declined significantly since the 2023 layoffs. Entire prefabricated housing blocks sit empty in the desert. The workforce has contracted by an estimated 40%. Subcontractor payments have been delayed. Multiple international construction firms working on NEOM projects have reported payment delays exceeding 90 days. 90 days overdue for companies that extended credit expecting sovereign reliability. The trust is evaporating. One senior project manager at an international engineering firm contracted to NEOM, who recently left the kingdom, described the situation on the ground. We received a directive in November to reduce active work crews by 40%. They called it a phased efficiency optimization. Everyone on site understood what it meant. The money has stopped flowing. Equipment from Germany and South Korea indefinitely postponed. Purchase orders canceled. Shipping containers sitting in Jeddah port because nobody has authorized payment for the final delivery. The budget crisis extends far beyond NEOM. The entire Vision 2030 portfolio is being quietly restructured. The Muqab Cube in Riyadh, indefinitely postponed. Qiddiya Entertainment City, scope reduced by an estimated 50%. Diriyah Gate Cultural District, timeline extended by years. The Red Sea Global Tourism Project has reportedly scaled back its hotel inventory target. Fewer rooms, fewer partners. Lower ambitions dressed up as strategic refinement, a market correction driven by evolving priorities. That is government speak for we cannot afford what we promised. The timeline of the oil revenue crisis reveals how quickly the fiscal foundation crumbled beneath Vision 2030. In 2014, oil prices crashed from over $100 to below $50. Saudi Arabia burned through reserves. The kingdom should have learned the lesson then. It did not. By 2016, Vision 2030 was announced with the explicit goal of reducing oil dependence. The irony is crushing. The program designed to end oil dependence was funded entirely by oil. Between 2017 and 2022, oil prices recovered. The kingdom spent aggressively. NEOM budgets expanded. New mega projects announced monthly. The spending looked unstoppable. No fiscal reserves were built. No contingency budgets established. Every dollar of oil revenue was committed to new construction before it even arrived. By 2023, oil prices began softening again. The 20% NEOM staff layoffs followed within months. But publicly, the narrative remained unchanged. By 2025, structural decline in oil demand made recovery to $96 increasingly unlikely. Budget planners began modeling scenarios that nobody wanted to present to the Crown Prince. And by 2026, the math has become undeniable. Saudi Arabia is spending more than it earns, and the gap is widening every quarter. Several converging factors explain why the oil revenue crisis is existential for NEOM specifically. First, NEOM has no independent revenue. Unlike established cities that generate tax income, Nebraska produces zero revenue. Every dollar of construction comes from the sovereign budget. Second, NEOM's remote location multiplies costs. Construction materials at NEOM cost 4 to 6 times more than in Riyadh. When budgets shrink, those multiplied costs become unsustainable. Third, the Public Investment Fund, which finances NEOM, has been hit by its own investment losses. Bloomberg reported an estimated $8 billion in domestic portfolio losses. Fourth, international investors who were supposed to co-fund NEOM have not materialized. The kingdom is shouldering the cost alone with a revenue base that is shrinking. Finally, NEOM competes with essential services for the same shrinking budget. Hospitals, schools, military, and public salaries all draw from oil revenue. NEOM is discretionary. Healthcare is not. The choice writes itself. The fiscal pressure is not hidden from anyone who follows energy markets. Financial analysts on Bloomberg Terminal have been publishing Saudi fiscal stress indicators since mid-2025. The data consistently shows expenditure exceeding revenue by widening margins. Quarter after quarter, Reddit is energy forums have tracked the connection between oil prices and NEOM construction pace in real time. Users compiled timelines showing construction activity declining in direct correlation with crude prices. The pattern is undeniable. International credit agencies have incorporated NEOM spending into their Saudi sovereign risk models. Moody's and Fitch both cited mega-project commitments as fiscal vulnerabilities. The rating agencies have named NEOM directly as a fiscal vulnerability. That language sends shockwaves through bond markets. Saudi Arabia has pushed back against the narrative. Official statements describe fiscal planning as prudent and strategic, with sufficient reserves to maintain Vision 2030 commitments. Prudent and strategic, that is government speak for, we are cutting everything that is not essential and hoping oil recovers. The consequences cascade through every level of the Saudi economy. Construction workers are being sent home as contracts expire without renewal. The workforce that was supposed to build a city of the future is being dismantled. Subcontractors who extended credit to NEOM projects are facing their own liquidity crises. Several mid-sized construction firms have reportedly filed for insolvency protection. The budget cut is cascading through the supply chain. Young Saudi nationals who were promised private sector careers through Vision 2030 are watching those opportunities evaporate. 70% still work for the government. The social contract between the monarchy and the population has always been simple. Oil wealth buys stability. When oil wealth shrinks, the question becomes what gets cut first. What does Saudi Arabia's leadership know that they are not saying? Internal fiscal projections almost certainly model scenarios where NEOM receives less than half its originally planned budget. Finding solutions requires acknowledging an uncomfortable truth. Saudi Arabia built its post-oil future on oil money, and now the oil money is running out before the future arrived. The kingdom has options. None of them are painless. It can borrow more, but debt has limits and credit agencies are watching. It can sell PIF assets to raise cash, but fire sales of strategic investments signal desperation to markets. It can increase production to compensate for lower prices with higher volume, but that would crash prices further and destroy what remains of OPEC cooperation. To be fair, Saudi Arabia has navigated oil price cycles before. The kingdom survived the 2014 crash. It survived the 2020 pandemic collapse, but previous cycles did not coincide with a $1.3 trillion spending commitment. Previous crashes did not face structural demand destruction from electric vehicles. This time, the recovery may not come. The window for course correction narrows with every quarter of deficit spending. Every billion borrowed today is a billion unavailable for the projects that were supposed to create the post-oil economy. The paradox is complete. Oil was supposed to fund the escape from oil. Now the escape has become the victim. Saudi Arabia's leadership sold the world a future built after oil. $1.3 trillion committed. 63 mega projects announced. A kingdom transformed, but the future was funded by the past, and now the past is running dry. Oil revenue crashing, NEOM's budget slashed, and the diversification supposed to replace oil has not arrived. The workers who built the foundations deserve better. The citizens who were promised transformation deserve honesty. The investors who were courted with confidence deserve the actual numbers. You were told oil would be replaced by Vision? Instead, the Vision depends on oil that costs $31 more per barrel than the market will pay. Your perspective matters more than any fiscal projection. Drop your thoughts in the comments. Subscribe if you want the truth about what is really happening to Saudi Arabia's economy. And this is just the budget. Wait until you see what happens when the credit agencies finally downgrade.